You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to our New Year's Eve show, Bob.
Yeah, it is the day before New Year's.
So what are we looking at as we wrap up the year?
Well, you get some seasonal things this time of year. One of them is a tendency for interest rates to decline into around the third week in December, end of December, and then typically can start a move of increasing interest rates generally. Now, it's another seasonal. You can have the Santa Claus rally, and we seem to have had that. And looking at the S&P, earlier in December it was down to 1993, and one nice bounce up to the 200-day and 50-day moving averages, which are close together, and then back down to just above 2,000, and then a couple of days ago up at 2081. So it's just trade since then is straddling those two lines, and they've been over the years pretty good helpers in trying to figure out where the market can go or will go, and it's struggling here now. I think maybe it'll decline, because we think that the financial side, like the banks, have been rather good. They did a bounce, and of course they got hit back in August and September when Shanghai got hit so hard, and they recovered out of that and made their best right in the early part of December, gone down, and then the trade now again is like the S&P consolidating just a bit below the 200-day and 50-day moving averages, and much the same is the case for the broker-dealers. This is the sector of the market where they have all the fun and have all the parties and wine, women, and song and bonuses. So that one set its high at 203 in June, sold off into September with the problems radiating out from Shanghai to 159, bounced back here right at the 1st of December to 189, a little above the 200-day moving average, and then it declined, and at the moment is struggling to right at the 50-week, so it's not looking all that strong. So the thinking we've been working on is that the financial side, the banks and financials and broker-dealers, although way off their highs, have been lofty recently and eligible for a decline, whereas the resource sector with oil, gas, and base metals have been very beat up. We were looking for a seasonal low for base metals in November, which we got, and it's sort of holding above the lows. We were looking for a big low in crude oil in December, and that one's trying to stabilize. And with these seasonal lows for these resources late in the year, oftentimes you can get a rally out to February or March. So we think that's still possible. The gold and silver markets have been interesting. Gold is attempting to bottom. Silver is not acting so well, and we watched or looked at a couple of pages recently guys who are silver bugs and do the fundamental analysis of supply and demand. And of course, every year you can point out that there's more silver consumed than produced, and therefore silver should go up. And these guys are really something else, because when they're forecasted all of the, they work very hard to put together all of the supply and all of the demand numbers. And when the forecasts don't work out, they can't look at their method because they think it's the best. So then they have to invent something from outer space and say that there's a conspiracy that the government is depressing, and let's talk about silver price. And so it's a very cheap out. Your forecast doesn't work, and you immediately shout conspiracy. And all we know is that when you're in wild credit markets and you're in a change in the credit markets from good times to adversity, the gold-silver ratio begins to act like a credit spread, where silver will fall relative to gold, which has been happening. And if you get a day, maybe sometime next week, where silver does a dramatic drop relative to gold, that's unpleasant for the silver bugs, but it gives you information that it's suggesting that the next problems in the overall financial markets are just around the corner. So we're not saying that silver may plunge next week, but if it does plunge next week, then it's telling us a story. So why these silver bugs can't see, it's simple. All you do is go back and look at the gold-silver ratio and the price of gold and the price of silver since about 1700. Do it annually, and it tells you a story what happens to each metal when you're in a period of speculative financial markets. So let's call the gold-silver ratio the metallic credit spread, and it's going against silver now, and there's no way that we can make the call that it's going to reverse and silver's going to go up. But at some point, maybe in the spring, you could have some relief in these markets, or I should say in the first quarter. You could have some relief in base metal prices and precious metal prices, and all it would be out of it is a trade. But in the meantime, a number of weeks ago, when gold shares were depressed, we advised accumulating a few just to have a position, and some of the gold shares are off their lows, and but it's not really a buoyant market yet. You've had one good rally out of September, but that was just with the basic markets and whatnot. But it's been a dull market here for those, and while we're in the festive season, it's quite a contrast.
We'll have more with Bob Hoye right after the break.
Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Bob, energy stocks really plunged this year. What are they going to be like in the new year?
There's a probability of a seasonal rally. Well, let's put it this way. The seasonal decline into December, maybe into January, is a yearly thing, and perhaps we're making the base now, and in which case a brief rally could follow. Yeah, we had crude set the low, West Texas, 34.53. Looks like December the 10th. Then it popped up to 38.28, and one of the charts we had was that if it get above 37.5, that would be constructive. Well, it did get there, and it's holding at that level now. And we'll see if it can get up. If it continues to base here over the next couple of weeks, that would be constructive. But the whole of the resource sector got so overbought you had the huge blow off in crude oil in 2008. That was on the peak oil story, where the oil capacity reserves were going to run out, and that theory didn't allow for changes in technique that brought on a whole lot of fracking oil. And our work in 2014 was that the rally up to that summer, when it was over, we were going into a serious bear market. And it had nothing to do with Saudi Arabia. Our argument was that natural gas had already crashed down to a new price regime that had yet to be seen for the price of crude oil. So, and typically, in the last post-bubble contraction in the 1930s, our estimate on the decline in crude oil in gold terms was that it would fall to perhaps 1/3 of the high, or perhaps 1/4. So that then, in ordinary pricing, suggested that crude oil could fall to 37, which it exceeded when it was down at the 35 level, or 27. And I think that sometime maybe late next year, that 27 level could be reached. The depressant would be the change in technology. The other thing would be in a post-bubble contraction, there's relentless pressure on most commodity prices, and the old saying in agricultural side is that the farmers plant their grains from fence post to fence post, because each year they're not getting the price they want, so they have to sell more to get some dollars. And I guess then the quip for crude oil comes that the producers then start drilling from fence post to fence post. So it's ironical, but it's the post-bubble deflation that's getting these things, and it'll continue. And of course, the business cycle prevails, and we're probably just ending the first business cycle out of the classic crash of 2008, and the first bull market for stocks probably peaked. So now we're looking at let's call it a U.S. recession. There was the Chicago PMI came out yesterday. The numbers looking pretty nasty. So it looks like a recession could be discovered next year, and that's not going to be a happy circumstance for most commodities. So all we're looking for is a probable bounce in base metals and in crude oil and in precious metals, with gold perhaps being the better item than silver. But the way we'd play the precious metal sector, and I've already mentioned it, is to be long a few gold stocks, looking for a nice trade into February or something like that. So, and that's our outlook for next year.
Have you taken a look at real estate, REITs?
Not REITs, but not in a year or so. Good idea, though. Should take a look. The real estate in Toronto and in Vancouver has become, I guess, highly speculative, largely driven by Asian money at the high end. And so prices are pretty frothy, and with the Asian economy softening and even their real estate is no longer going up, I think the endless bid for Toronto and Canada can come to an end.
Yeah, they predicted the prices in Toronto would only go up 5% in the new year and 7% in Vancouver. And considering they had, if you average between the two of them, a 16% rise in 2015, that's still a pretty good hike over 2 years.
Oh, it's been outstanding. Oh, in Vancouver, even the low-end prices have been fabulous over the last, say, 7 or 8 years. So no question about it. It's been outstanding, but I believe it is now rather speculative.
Bob, I hope the champagne is already on ice for you.
That's a good line. Well, it's not on ice, but it's in the refrigerator.
Close enough.
Very good.
Have a happy New Year.
Best to you, and best to our listeners out there in Radio Land.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments for the show to info@HowStreet.com. Happy New Year, everyone. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.